So if you've been paying attention to the recent news, the U.S. debt was recently downgraded by Moody's, and what the implications are for the economy and the markets, everyone's got an opinion on. But I saw a clip yesterday, a statement from Ray Dalio from Bridgewater Associates. He raises, I think, a valid point as it relates to something that maybe isn't being discussed as it relates to this downgrade and possibly what may be many more future downgrades to come. And what he says, and he warned on Monday, that Moody's downgrade of the U.S. sovereign credit rating understates the threat to U.S. treasuries, saying the credit agency isn't taking into account the risk of the federal government simply printing money to pay its debt. And we know it's doing that, and we also know that for the most part, if you, again, leave your comment below, it's going to be forced in the future to continue to print money to pay its spiraling out of control debt. He says you should know that credit ratings understate credit risk because they only rate the risk of the government not paying its debt. He posted on X. They don't include the greater risk that the country's debt will print money to pay, their countries in debt will print money to pay their debts, thus causing holders of the bonds to suffer losses from the decreased value of the money they're getting rather than from the decreased quantity of the money they're getting. Decreased value versus decreased quantity, according to the Bridgewater founder. They don't include the greater risk, right? So consider that. Moody's on Friday cut the U.S. credit rating one notch to A1 from A, citing the federal government's ballooning budget deficit and soaring interest payments on the debt. So that feeds into my next stories today. And by the way, markets closed off their lows for the day. Dow closed down 114 points, NASDAQ down 72, S&P down 23. But again, the story, I believe, is the continued weakening dollar. The Dixie dropped 0.4%, 40 cents, just barely holding 100. Okay, so we're almost getting back down into double digits on the dollar index. So again, the U.S. dollar continues to sputter, and we have to be paying attention to this because it impacts everybody. Two more stories dealing with this. That was the reason for the thumbnail and also the reason for the description of the video today, about 1,000 cuts. I saw this article on the Daily Hodl today. It says asset manager says U.S. government bonds no longer working as a hedge against risky assets, right? Traditional investment platforms always suggested to advisors that you have a certain amount of your portfolio in U.S. government bonds to hedge against, let's say, riskier assets. Maybe you get a little less yield, but in the event that the markets had some sort of a major decline, the bonds are supposed to act kind of like a safety net, if you will. According to this article, it says Kohlberg Kravis Roberts, KKR reportedly said the U.S. Treasuries are no longer an effective hedge against risk assets, creating a new demand for diversification. It says KKR, which had over $360 billion in assets under management as of the end of last year, says government bonds have ceased to act as shock absorbers for investors. During risk-off days, government bonds are no longer fulfilling their role as the shock absorbers in a traditional portfolio. Many CIOs are considering moving assets out of the United States toward other parts of the world. This guy also says the U.S. dollar is about 15% overvalued and that a weaker greenback is most likely approaching as Trump's new trade agenda develops. The traditional role of the U.S. government bonds in many global portfolios will become more diminished. The reality is that the U.S. government is burdened with a large fiscal deficit and high leverage, and its bonds are likely over-owned by many global investors who have benefited from both positive interest rate differentials and a strong dollar. This is, of course, last week Moody's downgraded the credit as deficits and debt have grown and interest rates have risen. Interest payments on government debt have increased markedly. Without adjustments, it says, to taxation and spending, we expect budget flexibility to remain limited, with mandatory spending, including interest expense, projected to rise to around 78% of total spending by 2035 from 73% right now in 2024. So, the projections are for the debt levels to continue to rise. So that means that more money needs to be printed to service just the interest on that debt. Hence, we are going to be, from my perspective, love to hear your thoughts and comments, we're going to be embarking on a road of continued dollar collapse, continued dollar decline, and therefore less appetite for countries and investors wanting to hold U.S. debt. Okay, we already know that China and other central banks have been selling U.S. bonds at a pretty rapid pace. I saw the 10-year was just below 4.5%. The yield was up a little bit today, but nothing massive. Last story I'll share with you is out of Fortune. And it says U.S. economy, and it ties into the same theme, okay? U.S. economy is experiencing death by 1,000 cuts, according to Deutsche Bank, as confidence, again, in national debt management erodes. America's soaring national debt, now over $36.2 trillion, has triggered growing concern among economists and credit agencies like Moody's that the U.S. credit rating, let me read it again, which recently downgraded the U.S. credit rating amid fears that economic growth won't keep pace with rising debt and interest payments. So growing concern that we have debt rising and therefore interest payment necessity rising. Economists have criticized politicians' plans to reduce the national debt as a little bit too little, too late. But analysts are warning that the issue is now coming home to roost, with the once unshakable confidence in the United States' fiscal future beginning to erode. And how does it erode? You start to see investors shunning bonds. You start to see other countries selling U.S. debt. It's a no confidence vote. America's debt, which currently stands at $36.2 trillion, is increasingly rising on economists' agendas. Okay, and what they're saying is, as the debt levels increase and the interest payments increase, this will basically drag down any kind of real economic growth. Such fears were reflected in the downgrade by Moody's. While we recognize the U.S. significant economic and financial strengths, according to Moody's, we believe these no longer fully counterbalance the decline in fiscal metrics. Okay, says the downgrade is yet another thorn in the side of America's fiscal health. As Deutsche Bank's Jim Reed put it in a note seen by Fortune this morning. He says, yesterday we felt like we were somewhere along the line of a death by 1,000 cuts with regards to the U.S. fiscal situation. Hard to know where in that 1,000 we are, but probably much nearer 1,000 than zero, even as yesterday saw an initial sell-off reverse as the session went on. At the end of the day, the loss of the final U.S. AAA rating late on Friday night doesn't change anything much immediately, but keeps the drip, drip, drip of poor fiscal news building up against the debt sustainability dam in the background. Okay, so again, it's slowly and then all at once. You've heard that. Okay, that unfortunately is probably what we're going to see with the dollar. And when the all at once moment hits, what plans what plans did you make, let's say, from now to that point in time to shield yourself from that? Are you considering investing in other assets like gold and silver? I know many that watch this show already get that. Are you considering investing in other assets, inflation and hedge assets like cryptocurrencies? I know many on this channel do not partake in that and are not looking to that as other investment strategies to, let's say, hedge against a declining dollar. But if you're not, it might make some sense to start looking into it now before you miss the boat. Banking on the Fed. Last part of the article says, in the event of U.S. debt buyers losing confidence in the country's ability to repay, America does have a card it can play in the form of the Fed. That the Fed could employ quantitative easing, a move that would likely raise eyebrows to lower long-term rates and make it easier for the government to continue borrowing. Problem is that the lower rates are not good. The fact that the debt will continue to spiral out of control, lowering rates will only again create a Band-Aid for how long, okay? And how much worse does it make it for, let's say, our kids' future and their kids' future, all right? So this is nothing new, but the stories I saw kind of culminating, obviously, starting with some stuff yesterday, Dalio's warning, which I thought was pretty astute, or his assessment, and the follow-on from this downgrade. I've got to be paying really strong attention to it, guys. It doesn't make any sense to be carrying debt you can't carry and shouldn't be carrying. It does not make any sense to not consider, I immediately stopped the double negative. Sorry, that's my lawyer in me. It makes a lot of sense, not financial advice, not trading advice, makes a lot of sense to consider some other investment strategies, okay, that are not that will flourish potentially in the face of this declining dollar, okay? Gold, silver, Bitcoin, things of that nature, okay? Hope you guys found this important. It does mean something for everybody, whatever rung you're at economically from your income structure. You can start at the very, very basics by just simply not carrying unnecessary and toxic debt. And then next, once you get yourself out of that situation, start a nest egg, start putting away a little bit every week or whatever you can. The next level from there might be to start thinking about acquiring some gold and silver as you can, and also looking into cryptocurrencies, okay? That being said, I went a little bit long today. Thanks for watching. Appreciate the support for the channel. Please hit that like button for me. And a free and easy way to support the channel is also just to simply subscribe. So if you would do that, I would greatly appreciate it. And I will talk to all of you soon. Okay, bye.